You've got 5 bank accounts, you're making your transfers, and yet you're still kind of cash strapped and confused for that matter. Does it sound familiar? If you haven't heard about it, Profit First is a system, and it's not that it's necessarily broken, but it's not necessarily a magic bullet you were promised. In this episode, we're going to break down where it works, where it flops, how to actually make your money flow in the business it needs to. And it's going to be interesting because Seanna and I are on different sides of the aisle almost sometimes with Profit First. We meet in the middle with some guidelines that we agree with, but she is a lot more pro and I'm a lot more against. So let's get into it and talk about Profit First today. Welcome to episode 5. Profit First isn't a magic fix. I am Caitlynn here with Seanna, and we are going to get into the details of a very popular system across social media, across the books, across the podcasts, and we're going to give our opinions from the accounting side and then the good and the bad. So let's start. Seanna, I'm going to kind of let you drive this bus today, but where does Profit First work? Where have you seen it successful and why?
Yeah, so I'm excited to talk about this. Caitlyn's a total Profit First skeptic. And when we merged in January of 2025, which we're going to talk about in later episodes, but we started off and I was like, I'm sorry, Caitlynn, my brain can't do this. I've been so used to using these different bank accounts. We're going to have to switch. We've got to get this set up. And she's like, whatever, you take the lead. You take the lead.
As long as I didn't have to do it, because there are banks, right? So we'll get into all of this, but there are banks that work really well with the Profit First system. We were at Blue Vine, does not work as well with the Profit First system because it's just not automatic.
Yep. But so I am a big fan of a modified Profit First model. I don't love everything about Profit First. I've seen it fail people and I have seen aspects of it really succeed. So I'm excited to talk about those different parts. So just to give the brief overview for anybody that's not familiar. So Profit First is kind of like a Dave Ramsey envelope method of managing your finances in your business. So it's saying if you get $1 of revenue, we're going to stick 50 cents into this envelope for operating expenses and 20% over here to pay the owner. I'm doing bad math.
I think we're at 70, so we're going to 30.
10% here for taxes and whatever. You get the gist. So we have these envelopes metaphorically that we're sticking percentages of our revenue into to cover those expenses and tax. So it's tax, owner pay, operating expenses, and then profit and income. So income's the main account. So we have these accounts set up and we're supposed to move money into these buckets and then run our business from those buckets. The first place that I see Profit First fail people is that you have to be profitable in order to put the profit first. I know that sounds really stupid, but we live in a society, in a reality where the envelope system just doesn't work. Sure, there are still people that go and cash their paycheck and put cash in envelopes and they live with cash in order to maintain a budget. I don't think that's realistic for most people, definitely not in business. And so as business owners, we commit to expenses ahead of time. It might be a year-long software subscription or rent of our building, any of those types of things. We're committing to expenses and we might have some down months where revenue does not meet the point of being that correct percentage to cover those operating expenses. I met with someone one time and they're like, I don't understand. Every month I keep having to pull money from my profit account to pay rent in my business. And I was like, well, let me pull your financials. And I looked at her P&L and I was like, well, you're not profitable. So there is no profit to be in the profit account. It all needs to be in operating expenses because even then you're still having to donate cash into your company. So that's the first place it fails. Is we can't just give up on good accounting principles because we decided to move money into some envelopes, metaphorically, into some bank accounts.
And then it kind of, to me, I guess my issues have always been, one, that it kind of feels like it sets you up for failure if you're not this perfectly evenly distributed MRR kind of company, so monthly recurring revenue, where you're like, I can guarantee that this money is coming in every month. It is frankly easier for us as bookkeepers who charge monthly rates to do this program because it comes in. So I always have a big beef with people being like, gosh, but I'm not making money. Or we have these up months and down months. And then what do you do in the up months? How much extra do we set aside? And then from a tax standpoint, I've always been very upset that it's based on revenue because it's over savings for taxes, which
Yes.
that money could be used elsewhere, investments, profit, paying yourself, savings, like so many other things. But I've got these business owners who have these huge accounts of taxes because they saved off of revenue, and taxes are always a net income thing.
Yes. So let's talk about that piece because that is the second place where Profit First fails business owners. I would like to go back, and I think Mike Michalowicz has some great books, like great concepts. So I'm not like fighting against that at all. But this percentage savings for tax is absolutely ridiculous. And I did a webinar one time with architects and engineers. And so there were a bunch of engineers on this webinar, and I presented my percentages for Profit First. And they were like, what? 7% savings for tax? That doesn't make any sense. And so I literally, because they're engineers, had to like sit there on this call and like say,
give them the math.
Well, here's the percentage of this, and you multiply that by, let's give you the highest tax rate, let's say 35% or 40 to include state. And that's why we get to this percentage. And they're like, it still doesn't make sense. But really, so I think in general, it's set at 15% of revenue. Well, I can talk you through the math. I'm not going to do it on a podcast, but 15% way oversaves for taxes for most people. You'd have to have very high net profit margins in your company. And even just based on it, like let's say you just work the Profit First percentages like he's setting up, you're still oversaving. Like if you're still having that 50% for owner's comp, if you're down in that lower revenue bracket, like it just doesn't make sense. And so then yes, people A, think they're failing because they don't meet these target allocation percentages, and then B, they're oversaving. They could have hired a new person in the business and taken some work off their plate, or like any sort of other investment. But instead, it was just sitting there all year long waiting for tax payments.
Yeah. And yeah, you've earned some interest, but it could have been doing a lot more in your business or your personal life for that matter. Okay. So we've kind of talked about the areas that we're like not so keen on it. But the truth is that the system exists for a reason, right? Like humans, as Mike talks about, really struggle with there's cash in the bank and therefore I get to spend that cash, right? And we're not so good at like, but it's for these things, which is where Sean and I were kind of struggling when we started. Is I preferred just a large cash balance. And I was like, I know that like all the cash I need is in there, but it was probably too high. Where Sean was like, but if we allocate this, we can bring some of it down, make sure that we're like paying ourselves important facts in business. Yes. And be set to go. So let's talk about where Profit First really excels and maybe the modified ways that you've seen it excel.
Yeah. So you hit on the number one biggest way that I've seen it excel is that it helps business owners believe they can pay themselves, because it's easy, especially like depending on where you stand from a money standpoint. You're probably either an overspender, like, hey, there's money in the bank account, I can afford this. Wait, I haven't paid myself out of the business now because there's no money. Or B, I need way more cash in the business than I think I need. So having that owner's comp account set up with money set aside to pay yourself. I've heard from clients, they're like, it felt so good to just like make that transfer of knowing I could pay myself and like giving myself permission. And that's the biggest thing, is like permission to pay yourself, instead of like, oh, but what if we need that for our next hire? What, all that kind of stuff that comes up for us. Right. And it's like nice to see that account sitting there like, nope, this is set aside for us to pay and enjoy. However, you have to make sure that those percentages are still working for your business. So it does take some, like over time, as let's say you've set up owner's comp is going to be 35% of revenue. Over time, we've got to make sure, well, okay, what percentage have we set up for operating expenses? And are your operating expenses still falling within that? And so this is where I personally have to flip what Mike does in the book on its head. And instead of saying, like, here's my percentage that I have to keep my business expenses within. Instead, it's like, are we keeping our business expenses within that percentage? It's like a subtle
like a
flip.
Yeah.
Yeah. It's more like a check. And yes, over time, we should be looking at our expenses and saying, do I really need that? Is it operating as efficiently as it should? Am I getting my full ROI on that expense? Those are things we should be doing as business owners anyway. I don't think the fact that you're like, well, this month I didn't make enough revenue to be able to afford that software subscription, so I can't have it until next month.
Yeah.
No, that's not how we make return on investment decisions within a business. So I think we have to flip it and say, am I still fitting these percentages? And if not, we have to look and say, like this happened with a client last year. She's like, oh, you're so profitable. You're doing well. She's like, oh, it's so nice to hear you say that because I felt like I was failing. I was like, well, why did you feel that way? She's like, well, because I kept looking at my profit first accounts and I kept seeing like the money was lower or I was having to transfer from this account into there to pay my expenses. Like, well, your business is still incredibly profitable. Like, let's look at what's going on. And it was that she had stepped up revenue level. So even like within Profit First book, when you step up certain revenue thresholds, you shift those percentages because you're running a different type of business. You have employees or contractors or whatever. So your expenses shift, less percentage goes to you, just that type of thing.
Got it.
And
Yeah.
so you have to go in and shift those percentages over time and just evaluate whether they're working for you.
And it helps to have a professional, honestly, walk that through you. And this is one of those things I think with Profit First that maybe threw me off too, is that you don't have to necessarily be a bookkeeper, accountant, like have that background to be certified in Profit First. And I think that makes it harder because, again, you don't have maybe that inclination to do trend analysis and to really dig into what that business should be earning, to like check the clients and be like, hey, we see all these businesses because we're in all these businesses. So it's actually not okay to think that you can run on 40% expenses. Your industry actually needs 60%. And so let's adjust these things. So that was always the other piece that I was like, but you don't know.
Yep.
And not that we want to gatekeep that information, just that there's this level of experience, I think, that comes with it. So speaking of those percentages and setting them, so you kind of have two things where we've seen Profit First. We've seen like the new businesses, which might be like the easiest time to be like, hey, I'm implementing this system. But then I have also seen clients who are running consistent net losses, have debt, meaning there's just no cash, and they're 5 years into the business, and then they want to set up Profit First. So like, how do we walk through those two things?
Yeah, I think so. First, for new businesses, we have to keep in mind that you need revenue in order to implement Profit First. It's all based on percentages of revenue. So if there's no cash coming in the door, there's nothing for us to be allocating. All right. So step one, build your revenue stream. Get clients coming to you, get money coming in the door, and then we can implement. If you're not at that point, you don't have consistent revenue, you're probably funding your business. Like you've probably made some contributions to it. So we're still like, if that's where you're at, you're still not ready for Profit First. If you're at the point where you have consistent revenue, then we can talk about implementing these percentages. It's a great time to do it. And I think honestly, the two biggest ones to implement are a tax savings account and the owner's comp account, just to
Yeah.
give yourself permission to pay yourself, really, and to make sure you're saving for taxes, because that's where everybody gets caught, especially new business owners who aren't used to having to make those tax payments.
Right.
When you see that balance sitting there that you've hopefully accurately estimated,
Yeah.
and you get to just like pay that money out and not worry about it. And then maybe at year end, you get a little bonus for yourself because you've oversaved into that account. That is a great, great feeling. So I think that implementing just those two accounts, just start with that, makes life a lot easier. And then the businesses that exist or have been existing and they have those high expenses, maybe they're at a net loss or a very, very low net profit. I think the first place to start for them is looking at those, the allocation percentage for operating expenses, and figure out where you're off compared to your industry or your revenue size. And there are probably things in there that you just need to cut. You've probably like invested, and I think we all get guilty of this from time to time. I'm like investing for the ROI. Like I'm willing to stretch on expenses because the revenue is going to come. And sometimes that happens and sometimes it doesn't. And we have to be realistic with ourselves as visionaries for our business. And so for them, first place to go is start cutting some expenses. And that might be hard, but if you're not operating at a good profit percentage, then you've got to do
You have
that.
to. Yeah, it's to keep the business going. New businesses, old businesses, what are like the best places to, like best banks for Profit First? Because like we said, Blue Vine was not great because we would have had to manually move everything. And that I think can be a deterrent for people.
Yeah, I love Relay, but that's where we ended up moving to. That's what I was using before. And they literally set it up so that you can run a Profit First model. I set up a rule for us. It's called Moving Monday. And every Monday, our percentage moves from our income account over into all of our other accounts that we've set up. It's automatic. I don't have to think about it. Everything just goes where it belongs, and it's super nice. You can certainly do it at other banks, but you might have more account fees because you're setting up all these different accounts. So you have to weigh all those things in. But I think Relay is safe. They have great customer support, just all those wonderful things that you want from a bank. And they're always innovating, which is very nice.
Yeah. And what about bookkeeping fees? So like a lot of bookkeepers will price, and I mean, we do too, based on accounts. And so how do you find a bookkeeper that like aligns with you and that, I guess doesn't make this necessarily more expensive?
Yeah, definitely the more accounts you have, the more reconciliations we have to do. So that does matter. Certain banks make it simpler. Relay will work with HubDoc for us and push statements over there if we set it up too. And as long as transactions are where they belong, reconciliations don't take very much time, which is very nice. But you need a bookkeeper that is on board with the profit first model and understands why things are going on, because otherwise those transfers between accounts can get messed up if they're not handled correctly in QuickBooks. So I think having a conversation with your bookkeeper, your potential bookkeeper, and making sure that they're on the same page and they understand what's going on is very important.
I agree. And for us, our company, at least I know we just assume you're going to have 5 accounts, and that can help. We're like, hey, we understand it. For me, I've always kind of like Seanna, I've always had that like tax piece. I have not had the owner's pay, and then the like investment for like the future of the company. So there's always a modified method that if your bookkeeper is willing to work with you on, it's just finding that experience.
Yes.
But yeah, it can be super helpful. It's just not always this like magic fix, especially if you're in the trenches of maybe not being profitable. It'll shine a light and it'll say, hey, we've got a problem, but it's going to be harder to implement if you're in this place of like consistent net losses. And so again, just finding someone really talented to walk alongside you if that's what you want to implement, and bookkeepers who support that. Because there are some who are just like, I'm not gonna do that. And if you can have an automatic bank do it, because again, not every person who's managing your cash might want to do that, you would pay for it. And so that's the other piece to keep in mind.
And I think industry wise, it's important, and they're profit first for real estate, profit first for contractors, all this different stuff out there. You do have to keep your industry in mind when you're looking at percentages that you're setting. We've talked about it in a prior episode. The net income we're going to have, the net income percentage we'll have in an accounting firm is not the same you're going to expect from a contractor or a restaurant or anything like that. So you have to keep that in mind when you're setting percentages for your business.
Yeah, otherwise it's unrealistic. And even if you're an S Corp, that's the other thing with that tax account. It's important to have, because even if you are a flow through entity, so like the entity itself is not paying taxes, you as an individual are. And so again, if you're working with someone who can help you map that out, that'll be really key to having enough and not too much. And then you can always, like we said on our last episode, we're kind of therapists on the financial side. So I think there will always be clients who are like, I need a bigger tax account because I am not going to write a check for my personal account that I'm not ready for. And there are some who are like, oh no, we're going to skate as close to that line as possible. And that's why you find the professional who works with you. Because it's your business, right? It's not someone else's.
Exactly.
So we hope we shined some light on Profit First for you, the goods, the cons. And if you've got more questions, you know where we are and how to reach us. And that's all in the show notes for you. But if you're calling and you're like filling out our form, just like note that you want Profit First, and I'll make sure Seanna's on the call for you. Thanks everyone for listening, and we'll see you in our next episode.